Good morning, Noah.
Good morning, Dr. Yeager.
What are we chatting about this week?
This week we're talking about what happens when my advisor moves, retires, or gets acquired, financial advertisements, and planning around current events.
Welcome to the Science of Wealth, where we discuss the science behind financial planning and the art of learning and applying it. Okay, so we're talking about the business of the planner career, how financial firms market to people, and current events, all sorts of fun times.
Oh, yeah. Yeah.
Okay, take us away.
So, start with what happens when my advisor moves, retires, or gets acquired. A little backstory of what prompted me to come up with this was my old firm, BSW, currently, or just went through Azure. So I have some questions kind of around that and what happens to the clients if that were to happen to one of them. So, question is kind of how often do you see these mergers or acquisitions or transitions in
It
the industry?
happens actually a lot, like a lot. It's something that's interesting because we're not doing that and we're not going to do that for at any point in the foreseeable future. But industry wide, there's an enormous amount of turnover, both in just the advisor by advisor, planner by planner level, but also just in firm mergers and acquisitions. For people's awareness, today there's about 310,000 people who give financial advice in some capacity. Some of them are just stockbrokers and insurance agents, but call it 310,000 people in the financial advice business. And it's expected that about 40% of them are going to retire in the next 10 years because the average age is like 57 or 58. And so, where that nets out to is there's been a study by McKinsey, there's another study by Cerulli Associates, but it suggests that in 2033 or in 2034, respectively, we'll have somewhere between a 75,000 and a 100,000 financial planner shortage in the United States. So, what that has all translated to is that a huge amount of firms, particularly small individual practices, are going into what are called roll-ups. Let's say a 60-year-old planner with maybe one or two support staff are getting acquired by a bigger firm. They're getting a nice 3, 4x multiple of revenue check. They're working there for another 2 or 3 years, and then they're sailing off into the sunset. That is happening at an enormous volume in the business right now. And then on the other side of the spectrum, even for bigger practices or smaller practices, a lot of firms come and go, fail, merge, partner up, break up partnerships, etc. So firms changing happens a lot in the industry, and sometimes some of those mergers affect hundreds or even thousands of advisors.
Sure. That some clients might have some firsthand experience with Daniel Stefanski going back to New Jersey. Not necessarily kind of your planner
Mhm.
moves on slash retires,
Yep.
even though he's not retired. So some clients kind of had insight into what the experience is like when a planner moves on. And given like what we're talking about moving on, what do you think clients should expect, not necessarily from us, or maybe also from us, just in case, but like in the industry as a whole, what are some common tropes when an advisor does a said roll up or moves on,
I think it really
retires?
depends on the nature of that transition. Just to highlight some of the obvious cases that are going to come up. There's the mergers, right? I'm part of a firm that's being acquired, or I worked with an advisor as part of a firm that's being acquired, or my advisor worked at firm A and now they moved to work firm B. Was this my first advisor? Did I become a client of the firm because of that advisor, or did I come through earlier on as part of something else and then I was later assigned to that advisor, or my original advisor retired, whatever it is. I think the biggest thing at the end of the day is no matter what we say or do as firms, clients get to decide who they want to work with. There's a huge ecosystem of like non solicits, non competes, headlines about like these multi million dollar judgments and lawsuits and whatnot because these are businesses. And even though sometimes people just say it's my career and they're my clients and I can do what I want, sometimes people end up on the hook for millions of dollars because it's not really the case. I think for clients more than anything, I think you want to give both sides of that equation a fair shake and respect what decisions have been made there. So we'll use Daniel as my favorite example here. When Daniel came to work with us, he already had a couple couple dozen clients at his prior firm, and he asked, should I bring them with me? And I said no, because we didn't hire Daniel A to just bring his book of business in, even though it's a very common thing, but because we wanted Daniel to focus on learning excellent financial planning with us rather than just like bringing over clients and assets and making more money on that. And in turn, as Daniel has departed us, he has taken some family with him, which is natural because they're his family. But otherwise, his clients that he's worked with have stayed here with us. And many of them only worked with Daniel when he was here, as far as like having a lead advisor relationship. But some of them also worked with Emily before that, or Greg before that, or me before that, where some of these folks have now had 2 or 3 advisors here at My Wealth Planners. And again, I think the core thing here is you want to respect the intentions and the good faith basis in which people come to work at firms. If they bring clients, they can probably take clients with them. And also just what the deal is that the advisor has and what value you derive from that relationship that you had with that advisor.
I guess that kind of ties into another question is like you had a great relationship with an advisor, they moved on, you continue to work with the firm. What are maybe some red flags that you see that kind of sprout up where, oh, my new advisor has XYZ problem, or it got acquired, this new firm isn't treating me how I would expect.
The
Common red
biggest
flags.
problem version of this I see, and we've not experienced it internally, but it's one that I witness and that we sometimes get clients from, is sometimes a advisor retires, quits, moves on, whatever it is, and the firm dumps all of that advisor's clients on one other advisor. And so that advisor goes from, let's say, 50 relationships to 100 relationships, or 100 relationships to 200 relationships, and they just drown in the relationships. And sometimes the way that they, I think, psychologically survive that is that they just neglect those relationships and don't serve them, don't communicate, don't work with them. And so that's something that comes up, is if you feel like the quality of your experience changes when your advisor comes or goes, then that's probably worth considering. And that's something where, again, sometimes you might want to follow them somewhere, sometimes you can't because maybe they quit, they passed away, they retired. But that's just something where your experience as a client of a firm should not be getting materially better or worse as your advisor changes or turns over. I think it's something that everybody has to be mindful of in the experience that they have with their financial planner, simply because at the end of the day, again, it's a voluntary ongoing relationship. And so just because they've had some turnover, some changes, doesn't mean that you should suddenly be experiencing a much worse experience, that you should continue to pay for a much worse experience. That said, some people are very happy with very little. We do have some clients that we work with here, for example, who we manage accounts for them and we answer their emails or their calls when they call or write, or we reach out every once in a while to see how they're doing. But they're very happy just letting us kind of run things, and they don't really ask much of us. We have 1 or 2 clients that we essentially see at the annual client party, and then we don't really see elsewhere. There's interesting experiences like that sometimes arise where at the end of the day, people want what they want. I think we sometimes assume people will want more than they do and treat that as a thing that they should be concerned about.
And I have some other questions, but we kind of talked a little bit about um, the overarching ideas of them. So I will move on to the next segment so we're not just repeating information that's already been
Yeah.
discussed.
Let me
So
let me I'm gonna add one more thing to this, which is I would be cognizant and cautious around whether a transition is good or bad. And I say that as somebody who has had a financial planner, and I say that as somebody who's had somebody leave the firm voluntarily on good terms, and I say that as somebody who's had somebody leave the firm voluntarily on not great terms. I think it's important to be mindful of the way in which that transition is communicated. I've always really tried to do a job as I could, making clients aware of the transition without burdening them with the drama of a transition, and vice versa. I've been in the position where I've left a firm, right? I started my practice under Waddell and Reed. I went independent, started my wealth planners. And in the process of doing that, I tried everything in my power not to say, I'm leaving because this is a terrible place. And it wasn't a terrible place. But I would just be mindful that some people leave for good reasons or bad reasons. And that can be on the part of the advisor or the part of the firm. And it's helpful when you see a turnover with your advisor. It's okay to ask, hey, why are they leaving or what happened? It's also okay to ask that advisor, that planner, hey, why did you leave or what happened? But I would be mindful that that's very much often a two sides of the story conversation.
alrighty, moving on to financial advertisements. So what initially sparked this for me was I was scrolling Instagram as you do, and I saw an advertisement for an annuity company that would offer 12% guaranteed return, and they'd buy out, so pay all your charges for the annuity that you're currently in. And in my that seems wrong or something something doesn't smell right here. And then recently, Twitter or X, whichever one you call it, is offering a 6% FDIC insured deposit account, and that is extremely high comparing it to similar items or similar blends for it. So, just curious as to your thoughts behind these offerings that seem too good to be true.
Well, I mean, good gut reaction on the annuity because that's a not possible B no product guarantees 12% return that way, and also it is illegal to rebate insurance policies for clients in the insurance industry. So, if somebody says like I'll give you the commission or buy this and I'll give you a percentage of it or something like that is explicitly against the rules. So that ad you saw on Instagram is probably just a scam or a con of some sort, because that's definitely not allowed or permitted and also not possible. In terms of then like the excess like Twitter offering now, and I'm a Twitter person. I'm never going to call it X. Twitter case of things, offering 6% FDIC insured, they have to have verified that or validated that with the FDIC. Like Robinhood got in trouble a couple years ago because they came out and offered like a 4.5% savings account at a time when interest rates could not support that. And they're like, it's FDIC insured. And FDIC was like, news to us. No, it's not. So I could see something like that happening with the Twitter case, but assuming it's actually FDIC insured and it's actually a valid at 6% return, the big issue there is you have to understand the rate environment. There is no set of like treasury backed guaranteed products that are going to pay you 6% right now unless you happen to find like a long-term 30-year treasury bond on a screaming deal for some reason. There's just nothing that can yield that 6%. Now, part of how that sort of offer works is that they're also charging a subscription fee. So part of how they can pay that is they're just rebating some of the subscription fee back to you. So it requires that you have like $6,000 or $7,000 in the account to not lose money on the interest rate in the first place. But assuming you have, let's say, $1 million to put into it, 60 grand a year is pretty great. The trick is those are not locked guaranteed rates. Those are just teaser rates. X or Twitter at some point, at any point in the future, can change those rates. And so it's something where a lot of financial businesses, particularly in the startup fintech world, where they don't really do financial service so much as just financial products, a lot of these companies come to market with incredibly great money losing deals. Like they will offer customers so much more value than the cost they charge to the customers can possibly offset. So they'll just lose money, and they'll lose money aggressively for years and years or even over a decade. And then once they've got widespread adoption, they'll change their rates or they'll change the terms and they will use people's inertia to get them to stay on board. So all of this to come back to like if it's too good to be true, it almost certainly is. There are temporary offers and arbitrages in the marketplace where firms, particularly firms that are like trying to get bigger, trying to grow, will offer products or services at prices that they can't possibly be making money on. But they're doing that in the pursuit of getting bigger to get more investors so that one day they can just sell the company, get an exit, and then whoever ends up buying that company, whether it goes public or they sell it to a PE firm or something, that firm will promptly like gut whatever made its money in the first place that made it such a good deal. And as long as people stick around, it'll start becoming profitable, but it will no longer be the good deal that it used to be.
And I guess is there this might get into something that we shouldn't talk about, but is there a strategy behind finding these like, oh, this is like this person is trying to gain business or this company is just trying to gain a share in the equity or of the industry? Is there a strategy where you can be like, okay, well, I'm going to take advantage of this, and as soon as they kind of start going towards, okay, we have enough of a foothold in this industry, we're going to start raising rates, that's when you go and find the next deal.
I mean, there can be, but this is sort of a classic example of the greater fool theory, which is kind of this idea of like buying a bad investment or buying into something or investing in something that is not great, but thinking, hey, as long as I don't get caught holding the bag and I can pass it off to somebody else, I'll be good. And that it doesn't have to be that malicious necessarily, but this idea of, kind of peddling in junk on the premise that you'll get out before you get burned. And this is sort of, even how like Ponzi schemes work, right? Early Ponzi schemes work because the early investors are getting money back from the later investors, and therefore the later investors are subsidizing the early investors. Like early investors in Ponzi schemes tend to do super well. It's just that at some point the house comes crashing down and somebody gets burned who's still in the house. So all that to say, it's something where Yeah, there's a strategy, but how confident are you in your to stay ahead of a impending catastrophe?
Kind of like back when crypto pump and dump schemes were all over the place. For those who don't may or may not know the terminology, pump and dump is basically a new coin or new NFT, whatever it might be, just launched, and it has like the backing of Soldier Boy, who's a rapper, just an example. And so people start investing into it because they see it as a good faith investment. It goes up, and then all the initial people who basically bought in, the people who made the coin, take all their equity out. Price drops to basically nothing, and then the public who were kind of lured into investing into this coin or asset kind of get left with the debt. So some similarities there.
Two things there. One, I like that you're talking about pump and dumps in crypto as if they're a historical anachronism and not still actively happening every single day. Like crypto is famously pumped and dumped constantly. So I think it's funny that you're talking about it like it's a thing that happened in the back in the day. The second thing that goes,
I guess it happened to me back in the day, so that's the only reason.
yes, well, the second thing would be that there's such a thing as like market investment commentary newsletters, right? There are people out there who are part of big publication barons or Motley Fool who share, lots of investment advice, tips, whatever. And some people do well and not well by following those or reading those publications and so on. On the other side of that, however, there's a whole ecosystem of essentially illegal newsletters. Because part of the deal is when you're part of one of these real publications, you have to have certain registrations and licenses. You have to make certain disclosures. You're not allowed to be advertising that people should buy an investment because you already bought that investment. So you're just trying to like jazz people up about it. But there's a huge ecosystem of financial influencers out there who are like, I'm an incredible day trader. Follow my trades. I've got an app. You can just sign up and pay $10 a month to follow my trades. And then it becomes a self-fulfilling prophecy because they'll buy something, they'll tell all their followers to buy it. The followers will buy it. That'll drive the price up. They'll look smart for buying it. And then they'll decide to sell it. And they'll say, hey, guys, you should sell it. And then they'll sell it. And then their followers will sell it. And then the price will crash. And once again, they look like geniuses because they've gotten enough suckers to just start underwriting their bets going either way. So everybody shows up late to a party to buy stuff they already bought or sell stuff after they've already sold it and drives the market in a way that makes it look like they're always right. So there's lots of versions of that where it's like, hey, if you're reading again the Wall Street Journal, Barron's, Motley Fool, more power to you. Do your homework on your investments. On the other side of that, if you're following some guy on YouTube or TikTok, and he's trying to get you to like buy into an app or follow his trades or something like that, you are just a pump and dump scam in micro increments.
Uh, I guess that kind of brought it back to what we were initially talking about, which is advertisements. Seeing these people on Instagram, TikTok, YouTube, Facebook, not on there. I don't know if that's on there, but I'm assuming it is. Kind of see these like, oh, I like sign up for my course and you will beat the market, or I guarantee the 12% income, going back to the annuity contract that I prefaced this conversation with. What should people be thinking about when they see this? Is it an immediate like, okay, well, this is obviously not true, scam, report next? Or is it more of a, this could be like, depending on the source, it could be like, okay, well, this is like Charles Schwab saying that they're opening a new investment account or a new high yield savings account that offers XYZ. So just thoughts on people saying guaranteed income or beating the market or something like that.
Yeah, I mean, the word guarantee is a scam. The phrase beating the market is generally a scam. I mean, I can tell you as a registered investment advisor, I get to use the word guaranteed for specific, well regulated financial products like certificates of deposit. I get to use it for things like US Treasuries. And I'm running out of options here because it turns out guarantees are not that common, and most things that are guaranteed are not that great. So if somebody says, like, hey, I guarantee you're going to make 14%, that is a scam. That is just outright a scam. The version of this you'll sometimes see is the phrase like target returns. We offer target returns of 14 to 18%. I can target a return of 100%. That doesn't mean I can deliver it. So I mean, there's just some very obvious like, hey, if it's too good to be true, it definitely is just a scam in the financial world. To the second part of your question about like institutional commentary or education, there's sort of an inverse relationship between the size of institutions and the quality of the content. Like no shade to Fidelity or Vanguard or any of these big companies. A lot of these big companies' educational content is so overburdened by like legal risk that it'll be something as simple as like you can put money into a traditional IRA and this may reduce your tax liability, and then that's the entire piece of wisdom, and there'll be like 8 paragraphs of legal disclaimers underneath it, where it's just not enjoyable to consume. I think on the other side of that, an easy filter to kind of keep in mind when you're consuming financial content is, am I being taught about concepts? Like, is somebody explaining time value of money? Or somebody explaining yield to maturity in bonds? Is somebody explaining contribution rates to retirement plans? That's all conceptual. And I think that can often be decent education. Your mileage may vary. When somebody's talking about, hey, this is the QQQ ETF, you should buy it, that's where I sit there and go, we're getting into specific investment recommendations without any personalized knowledge of who you're giving it to, and that is a problem. So that's where I think conceptual education can be useful, whether it's from big creators or small creators. When you get into specific do this type instructions, that's where I start to draw a line on quality and being questionable.
So the difference between education and a sales pitch.
Or just
Or
entertainment. Like the tax world is a great example of this. There's a basic law of physics in taxes. All income is taxable unless otherwise excluded, and all expenses are disallowed unless explicitly permitted. And yet there's this universe of like tax influencers who are selling like tax arbitrage things where like, oh, you open an LLC and then like you buy a car and you rent it back to yourself, but then you put the car in another LLC, and with that LLC you then put that in a trust and blah blah blah, and it's all invisible magic, and somehow it results in you making $1 million, driving a Lamborghini, and not having to pay taxes. Obvious fraud, like just straight up tax fraud. But there is good tax advice out there that explains things like how the home office deduction works, or that explains how, 530A accounts work or 529 accounts work. So, like, there's good education out there in all sorts of mediums, but the second it starts to sound like magic, we are entering into the land of fraud or cons.
what are some common, I guess, like the magic wand solve issues or make you rich immediately overnight kind of thing? What are some other tactics, if you know of any, that are designed to get the attention of an investor without necessarily just being fraud, like blatant, this is not accurate fraud?
The most common one I see is backtesting. So backtesting is where you say like, we've got a great hedge fund strategy or we've got a great investment product, whatever it is, and it's only been around for 6 months. But when we backtest our strategy back across to like 2020, right, or 2015 or 2010, it's incredible and it outperforms the market. And you go like, well, that's great, but you didn't actually do it. So that's a problem right out of the gate, because anybody can cherry pick a strategy out of history and say, oh, well, it turns out I should have, bought Bitcoin back in 2008, and then I should have swapped it for Ethereum in 2014, and then, in February of 2020 I should have gone all in on like Zoom, right? Blah blah blah. Like I can time the strategy perfectly by the power of knowing what happened. So there's that version of things where backtesting is abused. The other one is also you see quite a bit of just like flagrant misrepresentation and assumptions. So like a lot of sales pitches for insurance products like index universal life policies will compare themselves to something like a 401k, and they'll use an example assuming that you're going to pay like the maximum income tax rate in California. So net you're going to pay like 51% of your 401k out in taxes, and therefore, because your 401k is taking a 51% haircut all at once, it looks worse than putting your money in this insurance product that quote unquote guarantees against losses and participates in the market, blah blah blah, even though none of those statements are true. So there's a lot of stuff that, again, it's just this balance of there is always a relationship between potential return and the degree of risk that you take. There is no material or significant market asymmetry where you can make money without taking on risk. Or even if it is risk free, quote unquote, it's like, oh, I bought a CD at the bank, I bought a US Treasury bond, like that's as risk free as it gets. Sure, you still have risks like inflation, right? My 4% CD for 5 years might be great if inflation's 2%. It might be terrible if inflation goes to 6%. Now I'm losing money every year guaranteed. So even things that don't actually reduce your account balance can still end up being worse for you financially from just a value purchase power of dollars.
So that brings us into our next topic here, playing around current events. So talking about a little bit about, you mentioned inflation. There's plenty of other current events that we could talk about. Wars being a big one. Why do you think that current events tend to have such a strong influence on people's investment decisions?
Because human beings have a negativity bias. The status quo of your life is that everything's fine, right? You're breathing, you're fed, you're probably in a nice air conditioned building listening to this right now, or you're in your car and that's comfortable and nothing bad is happening. Nothing bad is happening to you 99.9999% of your life. And so negative events get your attention because the status quo of your life is generally good. And human beings have evolved because something going good just means that nothing bad is happening. Something going bad means you might die, right? It's a survival mechanism. So we tend to overweight negative events, discount positive events.
Okay. And I guess that kind of goes into the pain of losing versus the joy of winning. How you the joy that you get from gaining the next dollar diminishes quicker than the pain you feel losing the next dollar. So,
Yeah, I mean, I'll say from experience, right? We have collectively over the past 6 7 years made our clients, before I say this, I'm just literally going to articulate amount of money that's been invested with us, amount of money that we manage for clients, and I'm just articulating the gap between those numbers. But in the last 6 years, the amount of money clients have given us versus the amount of money that our clients have today is about 30 plus million dollars more than they had to begin with. Okay. So our clients are $30 million wealthier as a collective by having us manage their accounts than they were previously. I'm not making an investment claim there. I'm not making a performance claim. I'm just stating X minus Y. That's all that's happening there. Okay. I've never gotten an email from a client saying, Dan, the returns this month were so great, and I'm so glad you made me $26,000 this year. Thank you so much for doing that. Right. I've never gotten that email. I've gotten plenty of thank yous, to be clear, but I've never got nobody spontaneously gotten their monthly report and said, I'm so glad that I made $1,700 or I'm so glad I made $50,000. Right. Nobody's ever done it. Or inversely, I'm so glad I only lost $1,000 this month. Right? I've never gotten that, but I've gotten plenty of emails over the years being like, "Hey Dan, I see that we're down, or I saw something in the news and I'm concerned about it. What should we do?" I've gotten that email plenty of times, and so that's just sort of an interesting experience, right? Even though we have made clients way more money than we've ever lost clients historically, right? And again, I'm not making a guarantee, promise, or assertion that that will always happen in the future, but historically to date, that's what's happened. I've I can cannot begin to count the number of, hey, what should we do emails based on negative current events, but I can certainly count all the, hey, things are great, thanks for doing a good job, I'm so glad you made me money this month, this quarter, this year emails on one hand because I don't have any fingers to raise for that.
like, and so with those emails that you receive about like, I'm concerned about one thing that we had that was we had about 2 weeks there where clients were concerned about Social Security. How do you separate like meaningful information? So like the Fed is raising rates. That is material. Versus noise in the financial industry where, you know, person does something wrong and it's the end of Twitter.
I mean, that's sort of the a thing where it's like, look, there's the classic Epictetus diagram that has been popularized by Carl Richards. There's what this is what you can control, and you should focus on the overlap. You can control how you're invested. You can't control current events. So to some extent, you should be invested based on your long-term goals and be somewhat indifferent to short-term events. And if you want to make changes based on current events, it's always a two-part question. It's if we want to make this change now because of X, at what point will we make a change back after Y? And describe what Y is and how we think that happens, where that happens. How will we know that Y has occurred? And that's often a lot harder to articulate because when we make a decision based on negative current events, right, or concern about negative future events, it's often harder to articulate what would be different in the future. Again, keeping in mind that even though we live in a universe of entropy, the market has a generally positive long term orientation. So there should be a point at which the negative thing that happens sooner than later is overcome by something that happens later than sooner. But people have a hard time articulating and describing that event.
So then I guess this was slightly answered. So how often do you think investors should change their plan based off current events? Or maybe a current event that's like, okay, yes, you should be changing your plan.
I always like to use the phrase we take a largely passive index based approach, so we don't like to stand in front of oncoming trains. So, for example, the Fed meeting is happening this week. The current market anticipation is that they will not change rates, but we would be stupid as investment managers to hold a bunch of long term bond holdings for the indefinite future if we anticipated that the Fed was going to start raising rates aggressively, because long term bonds will take damage to their face value in a marketplace where rates are rising. That's an example of making a change based on current events or anticipated near term future events, recognizing that there is this just substantial potential for that loss. And therefore, we want to hedge against that risk by reducing the duration of bond holdings and getting away from that. But that has to rely on that presupposition. But other than that type of like super obvious, they're going to wave a giant sign saying we're going to raise rates and you would be dumb to ignore it sort of thing. Most current events are not things you should be making changes on your portfolio for. The only time I think it's a really good idea to make portfolio changes in terms of like your strategy, your risk reward, and so on, is either the market is really good. We're at our all-time highs. Great. Let's go ahead and de-risk, right? Now is the time to de-risk while things are valuable and nothing bad is happening. Or conversely, the market's down 20, 30%. Maybe it's still going down. Who knows? Maybe not a bad time to get more aggressive because everything that was aggressive previously is now on sale. Most people tend to want to do neither of those, right? When things are good, they don't ask us about de-risking. When things are bad, they don't ask us about getting more aggressive. But we hear the inverse occasionally, right? Now that things are bad, should we de-risk? No, it's too late. Now that things are good, should we get more aggressive? It comes up occasionally. Some people have that fear of missing out, but most people seem kind of happy with their level of risk reward. And we tend to mostly hear, again, back to negativity bias, should we be de-risking questions, usually being spurred by current events that are prompting concern about the risks or that have caused risks to already occur.
So when someone is emailing you or calling us about something in the headlines or the market's going down and they want to increase risk, decrease risk, whatever they say, what do you think is the best way to kind of handle that conversation? Like from my point of view, I think I might get a little hung up on, well, if you tell me to do something, then I should do it, but I will inform you on what the possible outcome could be because of that. Because at the end of the day, it is always the client's money and they get to decide. So, kind of, how would you handle someone who comes to us kicking and screaming, crying, whatever you want to call it, and is extremely worried about something that's going to happen or something that they read in the headline? What kind of tactics do you have to handle that?
My question is always what the short term harm would be if their concern came to pass. So, for example, somebody says, "Hey, I'm really worried about this event and I think I could lose a lot of money and I'm worried about that." Okay. Let's say you're a retiree client. So, you're worried about losing a chunk of your retirement and you're living on your retirement. What alternatives we have available to us if that thing comes to pass? Right? Do we have home equity? Do we have a HELOC? Do we have a cash reserve? How much runway do we have before we would have to sell investments at a loss if a loss were to occur? And what options are we willing to push or pull there? This gets back into recent conversations about reverse mortgages, for example. Or again, you just using available home equity or using a cash reserve and any number of strategies there. Or just, hey, could we sell from the conservative part of our portfolio that's not really going to lose a lot of value if that event happens? So can we stick to our existing investment strategy and use different short-term tactics to hedge that risk if it occurs? Or you're not a retiree, you're in your 30s, your 40s, you're saving, you're accumulating, and you say, like, oh, I'm really worried the market's going to go down. And I'd say, well, that would be great, wouldn't it? Because if the market goes down and you're still saving and investing, good news, you can buy stuff on sale cheaper than it was yesterday. What a great deal. The market's a weird mechanism, right? And I'm not the person who made this observation the first time, but it's one of the only places in the world where people will get happy that things got more expensive and will be sad that things got cheaper.
Yeah, that's kind of true. I never really thought about it that way, but yeah, you're not wrong.
I like to say seldom, but probably more frequently than I'd like to admit.
Alrighty. Well, those are all the questions that I had for you today.
Well, that's easy because you know that I have questions
Yep.
for you. So, as always, Noah, what have you learned since the last time you were on the podcast that you'd like to share with folks?
So you and a client had a meeting where I thought I like, I'm more educated than the average person when it comes to financial literacy, but you and this client were going back to back on like throwing terms out it was like Mach 5. Stephanie actually had a very funny anecdote about it. It's like watching two professional ping pong players, and that's exactly what it felt like because I couldn't keep up. But I saw the value that's added when you know your client, not necessarily just their financial circumstances, but how they communicate financially. And I saw the different type of prep that you did to anticipate some questions that might come up, and you had these things laid out, and you went really granular into, okay, well, your holding is, these are all heckles, like 54.98% this, and then like 22.18% this. So I saw the value that adds, just knowing how to communicate with your client. And also I think that the client very much enjoys the meetings. So that was fun to watch.
Yeah, I mean, here's the thing. I like pretty much everybody we work with as clients, and some people are more engaged or less engaged. But this client and some other clients can really play financial ball, and it's fun to get to stretch those muscles.
Yeah, and it's a little intimidating when you're sitting next to it, not fully understanding what's happening, but I'll get there.
There you go. That's the right attitude. The Science of Wealth is produced by My Wealth Planners, a registered investment advisor in Colorado. The theme song is This Is Your Time by Dan Phillips. The podcast is intended for educational purposes only and is not investment advice or any other form of advice. Not all material discussed on the podcast is appropriate for every individual in every circumstance, so you should consult with a certified financial planner, tax professional, or legal professional as appropriate before attempting to apply any of the subjects, strategies, or tactics discussed on the podcast.